So that image there, that's myself and my business partner, Matt. To introduce ourselves very quickly, we are mortgage brokers. We run a brokerage called Unbroke. And we started the business together. We were friends and then decided, to go into business together. So he might join us for some future sessions as well. So what are we doing here? This is actually not our first event. Sorry, it's our second event, but our first one around investing specifically. We did another session more on owner-occupied properties for 2024. But today we're going to go through a range of different things. As I said, I won't reiterate myself because I know we're all busy people. So let's move on. This is actually, and I did this in our last session as well, just to start off with a look at property prices in the last, I think it's around 30 years there, so since 92. As you can see, the property market does go up and down, and throughout today we'll have a look at, property versus maybe some other types of investments, and both the potential opportunities that property offers as an investment class, and also some of the risks to watch out for as well. As we know, with most investment classes, they do go up and down. And as you can see here, property is no different. It's had its ups and downs, but over the long term, we have seen quite significant capital growth, as we would all know, having to live in properties ourselves, whether we own or rent. They have seen significant growth in the past 30 years. So I was actually visiting my granddad on the weekend, and he was talking about, it was my great-great-great-grandfather. He'd been given a grant of land in 5 Dock that he bought 5 houses on, so he didn't have to pay any money for that land, and we were just laughing about how he should have held on to those houses because they'd be worth a lot today. But yeah, just crazy how much it's grown in the past few hundred years, but even the past 30 years has just been crazy. And if we look back at just the past year, what we can see is property prices still going strong. Now, 2023 was a really interesting year. I think there was a lot of difference in opinion when it came to what 2023 was going to look like. I think if we looked at the low interest rate environment, which was kind of 2019, 2020, it was no surprise that people were borrowing higher amounts. There was low interest rates. The property prices were growing all the way up to the end of 2021. 2022 was a bit of a softer year, but then 2023 was kind of this unknown ground because interest rates were going up or were getting really, really high. And so no one really knew what was going to happen. But what we saw was a lot of the capital cities really, really growing a lot. Interestingly, capital cities performed a lot better than regional in 2023, which, there can be a number of reasons for why that would have been. We have seen, some return to the cities after COVID. I think 2020, 2021, a lot of people look to go regional, look to move out of the cities, but the cities have kind of come back fully to life after COVID. And we've also seen the return of a lot of international migration. So, up to record numbers of overseas arrivals to come to live in Australia. So, number of different things happening there. And, Australia is still a very desirable place to live. So, Sydney, for example, there in the last year, a total return of 14.3%. And the strongest capital was 20.7%. And that was actually Perth, followed by Brisbane for 2023. So these cities that are, still have a lot of job opportunity, they're growing, they're having a lot of growth in population. But, they're also still a lot cheaper than the likes of particularly Sydney, but also Melbourne. You can see there, though, that Brisbane has actually overtaken Melbourne recently in median value. So a little bit of a change around what's attractive for people. Now, as we're talking about investment properties today, something that's also very important and that people want to know is all about the rentals and the rental prices and the rental market. So we can also see that rentals have been going up, and this has been happening quite recently. A lot of kind of content out there around people being unable to get rentals in the first place. So rents are up, but vacancies also down. And so what that means is renters are essentially being forced to pay these higher prices. Over the last year, you can see there Sydney's annual unit prices for rents have gone up 17.2%. Can we see a higher one there? Perth again. So it's quite similar, I guess, to what we're seeing in the property price growth that is being passed on then to rent increases as well. Houses aren't up as much when it comes to rental prices, but still significantly up for most capital cities. Hobart and Darwin are a bit softer on that one. So you can actually see Hobart unit prices actually went down in Hobart for rent last year. And I think there was a slight dip in house prices as well. Alrighty, so this one, you'd probably see a lot of lists out there when it comes to suburbs to watch, and every suburb is probably listed on some kind of list. I find it more interesting, less so the suburb itself, but more so the reasons why a suburb might be listed on one of these lists, because every provider out there, whether it's realestate.com.au or Domain or PropTrack or CoreLogic, they'll have a list of the suburbs to watch, which may or may not be correct. No one can truly predict the future, but I do like to look at why they've listed certain suburbs. So I thought this was quite an interesting list and a small enough list to have a little bit of a look. And if we look on the right, so the nominated for column, we can see some kind of common things coming up. And we'll go through some of these factors a little bit later, but location, for example. So if we look at certain locations, we can see Alexandria there being, I guess, close to the city. So that's one example of a location some people might like. We've got Avalon Beach there, again, beachside being a certain lifestyle or location that people would like. So it doesn't necessarily mean, when it says location, it doesn't mean there's one location that's desirable. It's location then combined with another factor. So, it's a location for a certain demographic, for example. And so it's important when you're looking at these things not to just take one element as well, but to actually combine a few and look at, who is actually going to live in that house, and then what the trends are going to be in the future as well. I was very happy my suburb, Elizabeth Bay, is actually listed on there for location and lifestyle. Why is that? It's close to the CBD. There's lots of nice cafes around. There's lovely water to walk by. So all of these things can start to play a part in the types of renters you might get, and also the capital growth you might get in the long term. And the difference too between, I think from a property investment standpoint, a lot of people, you might have heard, always buy a house, always buy a house. And that may be true for some suburbs, but it's definitely not a blanket rule. There are definitely some suburbs that have had really strong unit growth and continue to have really strong unit growth. And it also depends on what you're looking for. Are you just looking for capital growth, or are you looking for really strong rental yield and for really low vacancy, which means you're not, having it empty for a really long time? So I think back to the kind of starting point of looking at an investment, it's important to know what your goals are in the first place, and then actually find a property that aligns with that, rather than just going off a certain list. Alrighty, I did mention briefly just before, and I did include this in my last presentation, but international migration is back in full force. Australia welcomed 737,000 international migrants in the financial year 2023. So that was leading up to June 2023, which is a net gain. So if you take all the arrivals minus the people that left Australia, net gain of 518,000, which was a 73% increase from the financial year before. No surprise, coming out of COVID, it took a while to get back to those levels, but it definitely is back. And to that point, interstate migration, Australians are also moving out of, not in droves, but, significant enough, out of New South Wales and Victoria into Queensland and WA, due to, for example, house prices being more affordable. And you can definitely see that in terms of those states and cities really, really seeing an increase in both population. They are the highest in net interstate migration. Therefore, they're also seeing a higher property prices. Again, migration isn't the only factor, but they do tend to go hand in hand sometimes. More people, more places to live, it kind of changes the supply and demand curve. And then the third thing is urban sprawl. So as cities like Sydney are becoming more expensive, people still need to live close to work. So, the government is always looking at, should they rezone a certain area, for example, to allow more units to be built. So there's always opportunities happening like that when you're getting a city that's growing and growing and growing. And, a city like Sydney, pretty much every city in Australia, bar maybe a few of the smaller ones, definitely is still growing significantly. Alrighty, so let's have a look at investment properties and what, I guess, the makeup of investment properties around Australia is. This data was from the 2020-2021 financial year, which is, I'm not sure whether there is more recent data than that, but, still pretty recent. And it gives a snapshot of the investment property makeup of Australia. So if you look down the bottom, the total, around 2.24 million taxpayers in Australia are property investors. So a bit under 10% of the population. And collectively, they own 3.25 million investment properties. So actually, if we take, the working age population, it is a significant amount. It's definitely not the majority of people that own an investment property, but it is, a reasonably large amount of people that do invest in properties. Of that 2.24 million, though, 71% of those will only hold one investment. So you've only got about 30% of all property investors that currently own more than one investment property. So I guess the most common makeup of property investment is you've got your owner-occupied property and then one investment property, or you may own an investment property and rent, for example, which is something called rent vesting. And that is a trend that we're seeing more and more, especially for, younger people that maybe they can't afford a place that they want to live in Sydney. They may choose to buy an investment in a more affordable area and then rent where they want to live. It's just a concept called rent vesting. I don't touch on that too much in this presentation, but it is something we can go through in a later presentation if people are interested. So going down, you can read it there for yourself and look back in the recording and pause if you like. But when it comes to that kind of multi-property portfolio, you can see there that only around 20,000 people in Australia, or not even 1% of property investors, hold 6 or more investment properties. So it definitely is a smaller pool when you're looking at that kind of people that really want to build a large property portfolio. Okay, so owner-occupied versus investment property. I guess really depends on your goals. There's no should I not. The first thing I'll mention is owner-occupied versus investment. We all need something to live in. So I think it still is a goal for a lot of people to own something to live in, but it's definitely not the only way to do it. Why not both? You can definitely do both. But if you are a first home buyer or first property buyer, an important thing to note is if you choose to have your first property as an investment property, you won't be eligible for a lot of government schemes. So it's just something to know. A lot of the government schemes actually have a residence requirement. Now, something interesting to mention here is a lot of these residence requirements, they've moved from 6 months to 12 months. So you have to live in it for 12 months, but you can move in any time in the first year. So for example, if you were living overseas is a good example. If you're planning to move into state, you wanted to buy your first home in the new state, but you weren't planning to move there for 6 months, you could still buy a property, for example, and then you could start living in it 6 months later, and then as long as you lived there for 12 months, you could potentially still be eligible. There's other eligibility criteria, but that's just an example of how those schemes work. But you do have to live in it sometime in the first 12 months and live in it for 12 months. Tax, again, I will not give tax advice. If you do have questions that are specific on tax, either go and see an accountant, or the ATO website is actually really, really helpful when it comes to everything to do with tax. There's so many resources out there that you can go and have a look at each different scenario. But generally, an owner-occupied investment, you don't pay any capital gain. Sorry, not an owner-occupied investment, an owner-occupied property. When you sell that, you don't pay any capital gains tax on any growth that you've gotten out of that property. Whereas with an investment property, there may be capital gains tax essentially that you need to pay on the sale. On the investment property side, there are potential tax incentives, not just on capital gains on the owner-occupied side, but more around the costs of owning that property. Again, the ATO website's really, really good for understanding that a little bit more. You can earn rental income, so you've actually got an income-generating asset there as well. And an investment, again, I mentioned rent vesting. You may be able to buy an investment property in a cheaper area versus buying an owner-occupied property somewhere you want to live. Alrighty, so kind of explained it in the last one, but why do people invest in property? There are a number of reasons, probably more than this, but 3 kind of big ones would be the opportunity for capital growth. As we can see in the historical chart, properties have grown quite a bit over time. There's regular income. So investment properties are usually rented out to tenants, offering regular income to owners. And I guess from a loan perspective, if you buy a property, if you stick to your monthly repayments, for example, over 30 years, you pay down that property, you've then got essentially no cost to have that asset. That's actually wrong. You will have costs, you'll have management fees, you'll have maintenance fees, things like that, but you've got no loan cost on that property is the specific term there. And so what that means is any rental income, once you've paid off things like your maintenance and your strata and your management fees, that's actually just money sitting in your pocket. You're not putting any money towards a loan once you've paid it off. So it is an interesting one. Yes, at the start, you're going to have a significant loan there potentially, and you'll be using the rental income to kind of pay that off for most people. Over time, as the loan balance gets lower and as rents generally increase, that balance kind of changes. So it's really, really important to think of the long term, especially we'll go into things like calculating rental yield later on, but over time, that rental yield calculation and then therefore, the cash flow that you get from that investment property does change. It's not a static thing. So it's important to know that as well. As your loan goes down, the market changes, the property value goes up, or hopefully goes up, and then rents go up as well. It will actually change your position quite significantly in the long term. And then the third one there, potential tax benefits. Again, ATO website for that one. Now, to balance the other side, some risks of investing in property. It's always good to cover those off and make sure you know what you're doing before you get into it. So a lack of liquidity. Compared to, for example, cash or an investment like shares, buying and selling properties is a big deal. It's a lengthy, costly process and requires multiple parties to be involved. And it is a big decision. It's not something you can just snap your fingers and get out of in a day. So you want to make sure that you're really confident going into it. The second thing is vacancy and tenant risk. So owning an investment property does have ongoing costs. And if you're unable to find a tenant or a tenant moves out and you've got a few weeks without any income, that's a bit of a risk, I guess, in terms of your cash flow. So you want to make sure you've got enough there if that does happen. And tenants, may not treat the property well. I'm sure we've all got plenty of examples of people that have owned investment properties that we know and have horror stories. So it is, something just to consider. The good thing is, when you do get a tenant, they will often give you quite a bit of information about the tenants and you'll be able to make that decision. But it is always a risk there too. And then the third thing is market and economic risk. Now, while property prices have gone up in the long term over the past, we don't know what the future holds. We've seen a number of kind of crazy things happen in the past 10 to 15 years, everything from the GFC to COVID. So, you want to make sure that you do have that long-term view and that you're also set up if anything does happen. So making sure you're financially stable and whatever that means to you, just important to know what you're getting into. Interest rates there, I've mentioned at the end, nothing we love talking about, but interest rates do move. So you need to kind of build that into your goals and your strategy around investing as well. Alrighty, so the process for buying an investment property. Now, there, I guess, isn't necessarily a different process to buying an owner-occupied property versus an investment property. The funny thing is when people buy an owner-occupied property, right? Or sorry, I'll start with investment. When people buy an investment property, they're much more likely to do a lot of research, right? So they'll go and they'll research the area and the property and do, really, really good analysis on, is this a good investment? Arguably, people should be doing the same thing on their owner occupied or where they're planning to live. But I guess the different mindset there, people sometimes don't really consider the same things when they're buying somewhere to live in, but it is important to consider those factors as well. So we'll go through the factors in a moment, but just an interesting one there around the difference in emotions when people are buying an investment and the way that they research versus an owner occupied property. But the process is more or less the same. Again, the first step there, you don't always have to speak to a broker. We'll go through at the end why you may consider using a broker, but a broker can help you essentially understand where you're at and your loan options and what you can afford to borrow. You then get pre-approved. So this is essentially the lender saying, yeah, based on your current situation, we're more or less willing to offer you or to lend you a certain amount of money. that then gives you a degree of confidence going in to make an offer on a property. So it is something a lot of real estate agents will ask for before making an offer. They'll say, are you pre-approved or do you have conditional approval? And what that means is you've given the bank a lot of details around you, your financial situation, and they've said, yep, with a few potential conditions. So for example, the property needs to be within their policy. So yep, if you purchase a property within this policy in the next 90 days, we're willing to lend you that amount of money. And so that gives you that confidence. You make an offer. Let's say everything goes well. You sign the contract, you pay your deposit, and then you move through to settlement. And I know I'm going through this quickly. If you do want any more information about the property process, you can send me an email afterwards. I'm Rachel Rachel at unbroke.com.au, or we've got info@unbroke.com.au as well. And we can sit down and do a proper session with you to understand this a little bit better. So moving on to settlement, usually 4 to 6 weeks after you sign the contract, you'll have settlement day. And this is the day when it's essentially yours. So all of the money changes hands, and you've had the contract, so it was legally yours, but this is when you actually are able to either rent it out or move into it if it's an owner-occupied property. After that happens, you essentially move on to what most people do with their investments, is renting it out. Now, there are a range of different investment types. We're not going to touch too much on commercial or more land investments in this session. They're a little bit more specific, so we may do a session on those more specifically in the future. But if you're doing a residential investment property, you'll normally then get in touch with a real estate agent. Now, funny, I've got a friend that's American. Now, in Australia, it's pretty much everyone that owns an investment property will go through a real estate agent or a property management agency to manage that property for them. And depending on where you live, the fees do differ a little bit. In Sydney, it's around the 5.5% mark. So 5.5% of the rent that you get will go to that agency for managing the property. Now, in America, it's actually a lot more common for people to manage their own properties, which is just an interesting fact. So I have an investment property, and we use an agency, and what they do for us is they're essentially the conduit between us and the tenant. So that's everything from when we were renting it out for the first time, they came in, they would take all the photos. They actually did the whole rental application system for us, so we didn't need to find that on our own. They got all of the offers, they brought people into the property for us. And then they would send us essentially all of the applications. And then once we decided on a tenant, they organize all of the contracts. And then from an ongoing perspective, it could be anything. It might be anything from getting the pest control done, and notifying the tenant of that, to getting repairs done. If the tenant has requests, they can essentially act as a conduit between you. And there are certain things, for example, that you can approve for the agent to do on your behalf. So if there's a repair that needs to be done under a certain dollar value, it means that the agent can just get that done and they don't even have to worry you. So there's a lot that agencies do. Again, it's not a must, but it is very, very common in Australia to get a professional agency to manage a property. Okay, so this is moving on to the factors to consider in an investment property. Again, I said this is something that people probably don't do as much when they're looking at an owner-occupied property, but I think more people should, because it means that you're actually, confident that the property you're going to move into is also, something that has good prospects for the future. So going from top to bottom, affordability. Now, I guess affordability may or may not be your top factor, depends on where you're at financially, but something that could be interesting to look at, I think, particularly around investments, is this idea of looking at suburbs that are close to suburbs that have grown a lot recently. I know this is something investors do, and they'll look at, okay, what's a suburb that's gone up quite a bit in the last few years? And then they'll look at the surrounding suburbs there, because there may be a suburb that is a little bit more unknown. So for example, I'm sure we've all got one that we know that's close to us where most people would know kind of the bigger suburb that's kind of the center of that region. but there may be a whole lot of dots of suburbs around there that are a little bit more hidden. So they may be lesser well known, which may mean they get less searches on the likes of realestate.com.au and Domain. But they might actually have a lot of the same characteristics that suburb that's seen the really big growth has. So they may be in a similar location, have similar amenities, similar job opportunities. And so that is something that some investors will look at, is where is an affordable suburb close to a suburb that's seen really good growth. The second one there is amenity, so level of lifestyle, so bars, restaurants, parks. Again, it depends on the demographic. So for example, if you are looking in an area that's really popular with young professionals, what are the amenities that are important to them? Another one, which is actually kind of with the third one there, family appeal. So if you're looking in an area that has a demographic of a lot of families, is that area close to good schools, or close to schools that, people, I don't have kids yet, but people will move to be close to a really good school. So actually looking at schools where people are trying to get into, I know there's a lot of them where there's the catchment area for that school, and families will actually move to that area just so their kid gets into that school. I don't know what they're called per se, but I know there are schools pretty much in every area that are really, really popular, and people will move to be close to them. On the fourth point there, location, again, proximity to the CBD or major hubs, or close to a natural amenity like beaches or water. Those two are always really, really popular. From a CBD perspective, it's things like jobs, having hospitals and everything else close by as well. And then beaches, especially in Australia, but I think around the world, are very, very popular for people to live close to. Investment prospects. So this one is more around the rental market. So how is the rental market? What is the vacancy rate? What is the rental yield currently in that area, and how has it changed over time? Gentrification. So this is when a suburb is changing. A perfect example of this would be a place like Redfern, for example. It's always listed in the gentrifying places, but essentially it over time, and particularly over the past kind of 10 years or so, has gone through a really big change. A lot more infrastructure being put in, and really, really kind of cleaning it up and giving this new modern face to that suburb. So if that's happening in a suburb, it can often be a sign that property prices will increase as well. Population growth, representing a projected increase in the number of locals. So that just means, again, supply and demand, more people moving into the area. I was going to say fighting over the same number of houses, hopefully not fighting, maybe an auction's fighting, but essentially needing places to live, whether that be to own them or to rent in them, which means, again, there's going to be more competition for that same number of houses. I didn't put it in here, but there's been a lot of talk recently just about the number of properties being built, and how it's actually not enough for how much our population is growing. So it's a massive problem, and potentially could be another factor of why property prices are going up, because essentially there's less to go around, and so people are getting a little bit more desperate to find something. Demographic change. So this one is more around less so the number of residents, but the type of residents that are living there as well. And I guess different makeups of people might mean different types of properties are more attractive. So again, to use myself as an example in the area I'm in, Potts Point, Elizabeth Bay, lots of young people, lots of single people. So an example is not having a full kitchen might not be a big deal for a lot of people that want to live in Potts Point. Whereas if you were to look a bit more out in the suburbs, if you had a unit that was under 50 square meters and didn't have a full kitchen, forget it, no one's moving there. So it's a really, really important one to understand the type of person and what they're actually looking for to suit their lifestyle. And then the last one, infrastructure. So looking at major investments in projects that will benefit the suburb or surrounds. A lot of this data is available on government websites, planning websites. You can actually go and have a look if you're interested in a particular area or council area. There'll be a lot of data on the types of projects they're building, kind of new roads, tunnels, schools, universities, commercial precincts as well. a lot of that you can actually find. And again, if there's jobs, if there's schools, it's likely that the population then will increase and it will bring more people to that area. Alrighty, rental yield. I did mention just before that this calculation is really important. It does change over time, so it's always important to keep looking at this. But this calculation, this is from Westpac, and it's a net rental yield calculator. So it does include as well the property costs, not the loan costs, but kind of the more general property costs that you might have before you get the full property value. This one, so it starts with the rental income per annum. You then take off the property costs, things like, where is it? It's all listed there. Council rates, rental fees, so that's your management fees, your insurance, and any strata that you might need to pay if you've got an apartment. And then you divide that by the property value, and that gives you your net rental yield. When it comes to rental yields and how important that is as a factor, again, it really depends on your goals. You will see quite a big difference in rental yields in different suburbs and more so different states and areas. What is common, and this is not a blanket thing by any means, but what is common is you'll see lower rental yields in cities or areas where property prices are high. So that means you're getting less rent per annum compared to the property value. And the general kind of idea is that the lower the rental yield, the more likely for capital growth. Now, that definitely isn't a rule though, because what we saw in COVID was, traditionally in regional areas, you have higher rental yield, lower capital growth. But during COVID, with so many people moving to the regional areas or buying property in the regional areas, we really saw, massive capital growth in regional areas and coastal areas. So it doesn't always happen that way, but it is something people generally say is lower rental yield, higher capital growth, higher rental yield, maybe potentially lower capital growth. To say that though, there is always exceptions. So important to look at both of those factors, both the historical capital growth in the area, the future potential capital growth based on those factors that we looked at there, and then also the rental yield and vacancy, looking at it as a whole picture essentially. And I think this is close to my last slide, and then we'll go into some questions. But something as well that always comes up around property investment is positive or negative gearing. Hearing, oh my God, sorry everyone, I put hearing. Hopefully everyone's hearing is positive. But this is actually positive and negative gearing. And we'll go through just the pros and cons of each type, so both positive and negative gearing. So to start off with negative gearing on the pros on the left. So you can see there tax benefits. So I'll read it out just to not get anything incorrect, and we don't want to give any advice here, but any net losses on your investment will reduce taxable income and thus reduce tax payable. This often benefits high income earners. Again, look at the ATO website if you want to find out the exact amount there. And tax deductions may compensate for income loss until property flips to being positively geared or if it is sold for a profit. So essentially, again, that's talking about using income losses on a certain property to then kind of offset once you sell that property. So there's so many calculators out there. I will send around, when I send the recording over email, some resources you might want to look at that are specific to investment property so that you can have a look. On the cons of negative gearing, you are still generating a loss. So there will still be kind of a loss that you've got to pay out of your own pocket for that. Even though there are potential tax deductions, you are making a loss. And then there is a greater impact on your financial situation if circumstances change, like a loss of rental income. So unlike positive gearing, which positive gearing is essentially your rental income is outweighing the costs of owning that property. So you are earning positive cash flow from that property to a degree. Whereas with negative gearing, you are actually making a loss. So you need to make sure you've got enough there to be able to fund that negative gearing until you, I guess, either sell for a profit or until that changes, the property value goes up, the rent goes up, and that turns into a positively geared property. So you do just need to, I guess, think a little bit more about managing your finances on the negative gearing side in the short term, particularly. Alrighty, and in terms of buying a property, now a lot of people, like I said, are looking to buy an investment property as their first property that they own, especially in today's environment. However, I guess the most common way to do it would be you might have an owner-occupied property that you've had for a little while and you're then looking to make your first investment. So I thought it would be helpful to just look at this diagram here, which is all about using equity in one property to then buy another one. This is an alternative essentially to having funds in cash or a deposit in cash to put down on that next property. It's quite a simple idea. So I've done a diagram here, but let's say you've got an owner-occupied property, for example, or one investment property and you're looking to buy another one. You've got your first property there, and let's say it's worth $1 million for the purposes of having round numbers. You've got a property worth $1 million. You've got a 20% deposit that you put into that property. So that's $200,000. And now different lenders might lend you more or less money depending, but the general rule of thumb is having 20% always sitting in there as your deposit. So the bank won't often let you go and take all of the money out of that property and have no equity left in there. But let's say you keep your 20% deposit, and over time, having owned that property, you've actually built up another $200,000 in equity. Now that could have been from either paying down the loan, or it also could have been that property's actually grown in value. You've gone and got it revalued, and they've said, let's say you'd originally bought it for $800,000, and you've gone back, you've gotten it revalued, and they've said, oh, it's now worth $1 million. That's $200,000 in equity you've now gained. So as long as you keep that original 20% deposit in, any additional equity on that point can actually be used then to fund another property purchase. So that's what we call available equity, which is the top. I couldn't quite fit it on the line there, but available equity. And that is the equity that you can pretty easily withdraw with a refinance and put that as the deposit into the new property. So you're then not having to front up. And I oversimplified here for the purposes of showing the example. It doesn't include costs like stamp duty or any other kind of application or lender costs. So you do need to consider those additional. But from a deposit perspective, you could actually take out that available equity and pop that into a new property. You can also use equity to pay for other property costs, but I just use this as a really simple example to show you how you can do it. You can see if anyone does have any questions, this is my last content slide. So feel free to pop them in the chat and then I'll go through them in a moment. So thought it would be remiss of me not to mention, as we are mortgage brokers here, why would you use a broker? So a couple of different reasons here. A broker can help you compare different lenders and loan options depending on your needs. So we are essentially working in your best interest. If you have a goal to build a large portfolio of properties, a broker can work with you to understand your goals to own, I guess, multiple properties, not just the one you might be looking to buy now. Again, if you have more of a specific query around investment strategy and financial strategy, you will need to go and see a financial advisor. But again, a lot of brokers will often work with certain partners that are financial advisors and accountants. So you can kind of get a number of different professionals in one if you do know someone in that space, or if you don't know who to go to, you can always go to a broker like us here at Unbroke, and we'll often have someone in each field that we can refer you to as well and work together to achieve your goals. The third point is around fees. So there's often no service fees to work with most brokers. That does include our business. The way we get paid is essentially once you've settled on a loan, if you settle on a loan, the lender pays us a commission fee. And what that's for is essentially we've done a lot of the work on the loan for them. We've already gotten it to them pretty much ready to go. So for that service that we essentially provide to the lender, they give us a commission on that. And that's all disclosed straight up front before you give a broker any information. They must be required to provide you all of that information, including how they get paid and things like that, so that there's no kind of smoke and mirrors behind it. And then the fourth point there, I did mention it, but a broker will often have, like we have, different partners, whether that be solicitors, buyer's agents, which again, we didn't go into in detail in this session, but a buyer's agent is essentially someone that you can use who will actually go and look at a lot of those factors that we spoke about for you. So they might have certain tools or certain systems that they use that could go and analyze a range of different properties. And they actually also go out and talk to real estate agents and essentially try to get a really good deal on a property. They might have access to properties off market before they hit the market. So they can be a really great resource and a really great service to use. There are often fees involved. And so some people go not willing to pay the fee on that, but they are a service that's available and they are used by quite a lot of investment property owners or people that want to look at that because they want to make sure that they have essentially all of the data and that they're making a decision that's got a decent likelihood of seeing success in the long term. So essentially, to sum it up, brokers can also find you a range of other professionals that can help you along your property journey. And I will actually stop sharing my screen. This is our details if you do want to find us. We've got a website, unbroke.com.au. You can email us. We're also on Instagram, TikTok, and Spotify. We're on all the channels. And we've got a YouTube, like I mentioned as well, where we will be popping the recording of this session too. I will email it to you as well. And I will share my screen and just get to a few of the questions. Feel free to keep popping in the questions if you've got them and I'll go through them. Alrighty. Great. Lots of beginners I can see on there. I hope it wasn't too much lingo for you. If I did go too fast for you, again, you can always email me or contact us on the website and we can go through a one-on-one session. We've got a link there to actually book in just a little session with me and we can do a half an hour together and really answer your one-on-one more specific questions around property if you are interested in starting your property journey as well. So a question from Enza there. If you buy a dual key, yeah, I think Scott's answered it there. Thank you, Scott. Yeah, so it might be more specific on that one. So again, the government's a really good place to actually start, the government websites. I'll send some information around about the schemes as well. But there is residence requirements and you can't have owned a property before. So I'm actually not sure on the dual key. I think Scott said there it does vary by state. So go and check out your state government's website and they'll have information specifically about those schemes for your state. Again, there's different schemes for each state and the eligibility differs for each state. The first home guarantee scheme, which is essentially allows you to have a lower deposit. That one is a national scheme that's offered by a few different lenders, but a lot of the other things like stamp duty schemes, first homeowner grants, a lot of those are state-based, so it's really important to look at the specific state that you're wanting to buy in. Zach, a question, are two people able to come together to buy one property and essentially get access to the government first home buyer schemes? So again, if it is an owner-occupied property, yes, but depending on the scheme, either both of you must have never owned property. They have introduced a little one around not having owned property in the last 10 years. So have a look at that as well. But essentially, you both have to be first home buyers for most schemes. And then some schemes, there is the ability essentially to only have one of you, but it's pretty much more or less both of you have to be first home buyers. Again, have a look at the very specific scheme. If you want to just write it down or type it down, the two that are the most common in New South Wales would be the first home buyer guarantee scheme, and then the first home buyer assistance scheme, which is the stamp duty scheme. Again, that's not so much investment properties, but I hope that answers your questions. Jess, a question, if I individually purchase an investment property and my partner purchased another property, would she get the first home buyer? So if I think the scenario is here, you're buying an investment, your partner's buying an owner-occupied property, as long as you're both, I guess, the only person listed on that property, if you went and bought an investment and then you and your partner wanted to buy an owner occupied together, because you've already owned an investment property, you're not a first home buyer. So any scheme where you both have to be a first home buyer, you wouldn't be eligible for if you've owned a property before. Hope that answers your question. If it doesn't, feel free to email us and we'll get back to you more specifically. Question from Will: how does equity work buying another property if you own your first investment property with someone else? So Will, I guess if you and a partner went in on a property, you have 50% each, let's say, of that property. If you then individually wanted to go and buy another investment property, I guess you'd need to talk to that person, understand their goals as well. But you probably have to work with them in order to understand what is your value of that property and then how much then they were comfortable with. They'd have to essentially sign off on any kind of equity you'd want to take out anyway. But you'd need to work that out together, I guess, legally, to make sure that you're rearranging whatever you need to rearrange financially in order to draw that out. So to answer your question, it is definitely possible to still get money out if you're owning with someone else and you just want to take money out, but you would need to have essentially legal arrangements with that person, and they would have to agree in order to get that money out. But there's no, I guess, restrictions from a lending perspective on taking money out. It's more around you and that other person. Zach, this is a question to everyone, so feel free to jump in the chat, anyone, and answer. But how do you get started in property investing? I mean, I'll use myself as an example. I didn't even think about it initially. I actually just bought my first unit, and I lived in it for a little while, and then I thought, okay, I don't want to live here anymore. So essentially I moved out of that property into another property, and I just rented out the first one I bought. So I know my business partner, Matt, actually did the same thing. After a while, he was ready for something a little bit bigger. So it was a little bit less intentional for us. We just, once we'd kind of outgrown that first property, moved into a new one and rented out the old one. And all of a sudden we were property investors. Essentially, the important thing is buying an investment property. There are a range of factors to consider. There are professionals to help you along the process. And yeah, it's really up to your goals and where you see yourself, and the type of life you want to build and investments you want to build. Unless there's any other questions, I might leave it there and let everyone get back to their nights and to their dinner. But you can see on Meetup, we've got a range of different events coming up. If there are certain sessions too, or certain things you really want to know about, please email them through to us at info@unbroke.com.au, or pop it in kind of the overall Meetup chat, and we'll definitely take those as considerations for the events we run in the future. Really, really keen to hear some feedback, and I hope this was really helpful. If it wasn't, feel free to tell us as well, and we'll change things. So yeah, really, really appreciate your time. Thank you so much for giving me 45 minutes of your night. I know everyone's very busy, and the recording will be sent through very shortly at some point tonight. Thanks very much, guys.